Why you want to get paid today, not tomorrow. Congratulations! You're the lucky 150th viewer of this video. As your prize, I've decided to give you $1 million. You'll get your money as long as you answer the following question correctly. Would you rather receive your $1 million in one upfront lump sum? Or would you rather get 10 yearly payments of $100,000 each? You might think it just depends on your personal preference, but trust me, there's a right answer. If you answer that you want 10 yearly payments, then I'm sorry, you won't be getting your $1 million. The correct answer to my question is that you want all of your money up front. This is because 99.99% of the time, it's best to get paid as soon as possible for any money that you're owed, instead of agreeing to receive it at some point in the future. Learning and understanding this concept can literally help make you tens, if not hundreds, of thousands of dollars over the course of your life. This video is going to take a close look at why you want to get paid today, not tomorrow. Now, before I jump into it, I'm going to take my own advice and ask that you smash that button now, not at the end of the video. Each like goes a long way, and I really appreciate every single one. Now, with that out of the way, let's jump into it. Why money today is more valuable than money tomorrow? Let's go back to my original question. Would you rather have $1 million today or $100,000 per year for the next 10 years? The reason that you would rather have $1 million today is because of a concept known as the time value of money. The time value of money states that money today is more valuable than money tomorrow because of money's ability to be invested and earned interest. If you get paid today, then you'll be able to take this money and instantly start generating a return. You can do this by investing it in stocks, bonds, real estate, or even a savings account. By the time the year's gone by, this money will be worth more than the original lump sum that you were given. For example, let's say that you find a high-yield savings account that'll pay you 3% in interest annually. You opt to receive your $1 million up front and put it in this account. Over the course of 10 years, this $1 million will generate roughly $344,000 in interest. Let's compare this to receiving annual payments of $100,000. Each year you receive your $100,000 and put it in the same account that generates 3% interest. However, since you're starting with just $100,000 instead of $1 million, you will earn a much smaller amount in interest. Over the course of 10 years, you'll only earn about $180,000 in interest. This is almost half of what you earn by choosing to be paid in a lump sum. See? I told you that this decision could cost you tens of thousands of dollars over time. I know what you're probably thinking. This is all some random hypothetical situation. Since you're not actually getting $1 million, what does any of this matter? In fact, it matters a lot. Let's take a look at how you can use the time value of money to your advantage. Just because you aren't receiving $1 million, it doesn't mean that you can't still use the time value of money to generate interest on your savings. The first step in using the time value of money to your advantage is finding a place where your money will be able to generate a return. The most obvious place to start is a high-interest savings account. However, most of these accounts generate very little rates of interest. For online banks, the average interest rate is about 0.5%. This means that $10,000 invested in one of those accounts will generate about $50 in interest by the end of the year. For traditional banks, the rate of interest is much, much lower. Instead, lots of investors choose to keep their money in the stock market. On average, the stock market will return about 10% every year. Don't worry, this doesn't mean that you will need to buy a Bloomberg terminal and spend hours every day analyzing stocks. In fact, investing in stocks is probably much simpler than you think. All you need to do is download an account with a popular brokerage such as Webull, SoFi, or TD Ameritrade. These accounts have no account minimums and will not require you to pay a commission for each trade that you make. From there, you just need to buy shares in an exchange-traded fund, also known as an index fund, that tracks the entire stock market. Two examples are the Vanguard 500 Index Fund and the SPDR 500 Index Fund. These funds own shares of 500 different stocks, which helps protect your money from any downturns. Essentially, you are investing your money in the strength of the United States economy. As you can see in these graphs, over time, the shares that you own should grow in value. Over time, you can expect your money to grow by about 10% per year. This means that $10,000 invested in the S&P 500 should grow to $11,000 by next year. Now, this doesn't mean that your stocks will go up in value every single day. The key is to give the market time to grow in value. Even if your stocks are down over the course of a week or a month, there's still a good chance that they'll be up over the course of a year plus. The key here is that it takes time for these shares to grow in value. The longer that your money is invested, the better the chance that it will grow in value. This is why it's called the time value of money. Now, before we part ways, I want to discuss one last concept. This concept states that any money that isn't invested is actually losing value each year. That's right. You might be saving money very diligently. However, if you aren't investing, then you are falling behind. Let's unpack that a little bit more, but very quickly, I want to encourage you to leave comments below if you have any questions or have an idea of a video you'd like to see. I appreciate every comment and am sure to always get back to my followers. Now, onto our final concept for this video. Whether you're aware of it or not, your money is losing value every year. If you don't believe me, just jump back in time to 1970. During this year, a McDonald's hamburger cost about 15 cents. Today, the cost of that same hamburger is about $2.49. This is a whopping increase of about 1,660%. Not a small increase at all. It's easy to think that McDonald's is just jacking up the cost of the burgers to make more profit. However, this can't be the main reason for the price increase. If McDonald's was the only one raising prices, then other burger chains like Burger King would just undercut McDonald's prices and put them out of business. The reason that the price of a burger and the cost of living in general is always increasing is because of inflation. Inflation is the devaluation of a currency over time. It happens for a few reasons, but the main reason is that the government is constantly printing more money. As the government prints more money, they devalue the current dollars that are sitting in your bank account. This is the main reason that things seem to be getting more expensive across the board. Think about it. Rent, college, tuition, groceries, gas, and eating out all seem to be getting more expensive, right? This is almost entirely due to inflation. In fact, McDonald's has even had to get rid of its famous dollar menu due to inflation. In 2021, the average rate of inflation is about 5%. This means that your money is becoming 5% less valuable each year. You can think of this as the opposite of earning interest. If you left $10,000 sitting under your mattress for a year, it would only be worth $9,500 after 1 year. If this continues for 10 years, your money would lose 50% of its value in terms of purchasing power. In 10 years, it's possible that the price that you need to pay for groceries, gas, and rent has doubled. The best way to counteract this is to invest your money. If you can invest your money in a place where it grows at a rate faster than inflation, then you can stay ahead of the game. And that is why you always want to get paid today instead of tomorrow. So, investing in trends is one of the easiest ways to get ahead, right? Now, the problem is that most people don't notice trends until it's way too late. And let's be honest, by this point, everyone already knows about cryptocurrency, the metaverse, and electric cars. The time to get into these trends was back in 2015. Luckily, I've uncovered 3 new massive trends that are just beginning to take off. We're talking potentially world-changing stuff here. And the best part is that most investors don't even know that they exist. So getting into these trends today could be like buying Amazon, say, back in 2002. So to learn my 3 trends that could dominate the 2020s, click on the link in the description. Even if just one of these trends becomes mainstream, it could help you earn a life-changing amount of money. Again, thank you so much for watching, and I hope to see you back here next time.